2, 3, checking the sound. So, hello everyone, my name is Stan, I will be your host today on this streaming session. I hope that you see what I'm showing you, my broadcasting, and hear my voice, so hopefully everything works correctly. So let me double check on my side if it works. If it is, so we will start the stream right away. Just 1 minute before we get started. All right. One last preparation before we get started. One, two, three, four, five, six, seven. Let me double check with the team if they see my image. And if yes, okay, I think it works. All right, so hello everyone again. So I welcome you here on this streaming session. My name is Stan. I'm a senior trading specialist at Exness, and in this streaming session I will share with you my market thoughts and observations. Hopefully they will be useful for you. So I've been in the market since roughly 2004, so more than 20 years right now. So of course, first 5 years it was just education, learning, getting involved in the industry. So I started trading full-time since 2008, 2009. So I pretty much traded in many trading styles. So I can share with you some feedback experience from different styles perspective, either that's day trading or swing trading or position trading, or maybe scalping, if you will. All right. So in this streaming session, however, we will not go through specific, entries like putting the position, entering, placing a stop loss, placing a profit target, and yada yada. We will not specifically go through that, though I will share with you some trade locations as well. But we will replicate the top-down analytical process. Why I think it is important? Well, in the markets, traders usually do the same thing over and over again. So what essentially they do, they open charts, open a terminal, whether it's MT4, MT5, trading view, anything else, and they start being involved in the price section. But if you think about the price itself, so price may be deceitful because it's just the advertising mechanism. It just goes back and forth sometimes without any logic. So you need to interpret the price. You need to interpret the data. You need to understand what's going on in the market. I mean, the context, right? So that's why we are referring to economic news, to the context, what instruments are in play. So we are trying to observe this from the fund manager's perspective, from the other time frame, from the large time frame perspectives. That's one thing that we do. Another thing, we analyze the daily price action in terms of identifying potential pivot points or pivot areas, or the type of the day, whether it's a trending day or normal day, range bound day. Then we are building the hypothesis or the idea, the trading idea essentially. So that's a track which you expect the market to go through. And then execution part. Execution part is a strategy. For example, when you have the idea, when you bring the idea to the table, or some ideas to the table, whether it's 3-5 ideas, maybe more, then the next part is execution. You want to execute it with low risk because you might be not right. That's absolutely normal. Markets are uncertain. It's incredibly difficult to be right in every trade you make. Even though you might have great experience, vast experience, great skills, analytical skills, whatever it is, but still you might be not right. That's absolutely natural. Markets are not uncertain. So execution part is very important. So that's why we'll replicate the top-down analytical process in this stream. By the way, in hedge funds, they do just the same thing. But different people are responsible for different roles. For example, there are analysts which make analysis. Then there are portfolio managers who execute trades, and there are risk managers who manage risk. So basically, this team works together. I'm not saying about quants and algorithmic trading, but just about manual trading. In our trading, in retail trading, we need to combine all three personalities together in one person. All right, let's go. Without further ado, let's go straight to charts. All right, I'm showing you Exness terminal right now, so hopefully you see what I'm showing you right now. So that's gold, but let's start not with that. Let's start with economic calendar. For that purpose, we're going straight to Exness personal dashboard. I don't know if you've seen this dashboard, if you're not an Exness client, so you definitely should check it out, because we have here the incredible analytics tab, which combines three useful tools. The first is economic calendar, which is needed, absolutely needed for preparation for the day. Analyst views might be helpful, so if you don't have your own ideas, so you can push analyst views tab, and you would see ideas which are delivered by the independent vendor. In our case, it's Trading Central. This is a company which provides analytics for different currency pairs, not just vague analytics like, okay, it might go down, it might go up, depending on the economic situation. Not like that. It's just technical analysis, actionable, which involves destination and forecast, the actionable forecast. You may check it out too in Analyst Views tab. Well, generally, I also, sometimes check these ideas, because sometimes I just view the markets and I don't see anything, to be honest, or if I don't have time to analyze the market, because anyway, you need some time to sit down, to go top down, to dedicate some time. Sometimes I don't have this time, and I say, okay, so give me a quick snapshot about the markets, what's going on here, and I scroll down this feed and I get the idea of what's going on. For example, we have Forex, crypto, stocks, indices, whatever you trade. All right, and market news is another tab which you might use. It's actually the news stream or news feed delivered by, I believe, FX Street. So that's a very popular portal for CFD and Forex traders and commodity traders. You can also check it out. So these are news that are delivered right in the dashboard. But let's start with economic calendar though, because we don't need yet any other people's ideas. We want to build our own, okay? All right, so what do we start our analysis with? Believe it or not, we started with analyzing the American dollar. So what's going on with American dollar? Because America remains to stay the dominating economy, the dominating financial market in the world. And so I don't know, guys, what exactly do you trade, but most people trade anything against the US dollar. For example, whether it's Euro USD, whether it's GBP USD or USD versus Japanese yen, or even gold XAU USD, right? So that's why we're watching USD here in the first place. We want to know if any really important news are going to be published this week. So for that purpose, we're scrolling it down. So today is February 11th. And all right, so the first very important news, by the way, is going to take place on American session. That's a testify of Federal Chief of Federal Reserve, Jerome Powell. So he gives testimony to the Congress. Well, that's important news, because sometimes he delivers his view about the interest rate. Interest rate is the most influential type of information in the markets, because interest rate defines attractiveness of the US dollar in this case, and treasury bonds of the United States, and that's why it shapes capital flows. So later on I will explain you guys how to read capital flows with the help of yields of treasury bonds, of American bonds, but let's go step by step. So that would be testimony. Volatility may pop up during this speech. Usually, well, Jerome Powell, generally, he's not surprising the markets a lot, so he doesn't like to surprise the market. He's not Donald Trump, but whenever he speaks, sometimes he calms the market down, so he delivered some optimistic view, though that depends, of course, on the context. For example, the last interest rate decision, which was posted in January, so also there was a press conference from Jerome Powell. He was delivering his view. View was overly, I don't say it was pessimistic, it was neutral, but markets were concerned that interest rate will stay at the same level for the long time. All right. Nevertheless, that's important news. But I think the most important news publication during this week is, of course, United States CPI. That's inflation for the United States. It's going to be published on the United States session on Wednesday. Okay, that's CPI. That's CPI, which is going to be tomorrow, US CPI. So let's take a quick look of what does CPI stand for. It's published on the US Bureau of Labor Statistics website, bls.gov, which is accessible by the official website. I don't know if you guys prefer to use official websites. I do. So I always see information on the official websites. So I put some work. I think it pays off because you see the official source. All right, here it is. If you scroll it down, if you go to the right side of this website, you see statistics of these publications. For example, the last one, Consumer Price Index, was published in January. It includes information from December. Now the upcoming publication will include information from January. Let's check it out from chart perspective. Let's click on the chart icon, put here 2024 to 25 we don't have yet, but okay, that's fine, because it's still we have the data for 2024. We don't yet have the data for 2025. So you see that it was flat, 0.2. It was flat for a long time. It was surprisingly flat, starting from July, August, September, October, November. It was 0.2. It was at the same level, no changes. I thought even that it was even a glitch in statistics, but nevertheless, in November we had some uptick to 0.3. and another uptick in December to 0.4. That's why we have such expectations about the interest rates. If inflation goes up, if it persists, Federal Reserve, as central bank of the country, needs to keep the interest rate at the current level, not moving it down. At the same time, so interest rate is a double-edged sword, right? On the one hand, it can fight inflation. On the other hand, it can cut economic activity. So they need to balance between these two scenarios. They need to fight the inflation on the one hand, which is price stability, maintaining price stability, as they say. On the other hand, they need to boost economic growth or support economic growth. If they will, keep it at too restrictive level, so economic activity will shrink, which is not good. If they will keep it at a too supportive level, economic activity will expand, but inflation will also accelerate, which we've seen, by the way, this situation we've seen after COVID times in 2021. Inflation was actually accelerating a lot. All right, so market is expecting a little bit of a uptick. So to get the idea of a forecast, guys, we might go to tradingeconomics.com website /calendar. So that's an independent website. That's a third-party website. Though I think it might be useful if you want to know the forecast. I think they build pretty valid forecasts. The consensus forecast is 0.3. Okay. And let's click it here. Click on the icon with the chart. So yeah, they expect it to rise to 0.3. I don't know why that's core inflation. That's not an CPI, that's core inflation. And they have a forecast here. The forecast that in, I don't know why they don't have January, which is weird. Nevertheless, it's expected to go down a little bit, then to stay at this current level. All right, so what is interesting here, what is notable here? If the release number will be different from expected, that would mean probably the strengthening of the US dollar, because in that case, the market would be preparing for the interest rate to be stabilizing at current level for the long time. By the way, guys, to get the idea of the interest rate expectations, you can go to cmegroup.com/markets/interest rates/CME FedWatch tool. That's a website. That's basically a tool delivered by the Chicago Mercantile Exchange. So they take the derivatives on interest rates and build this tool as a result of that. So for example, you have tabs here. For example, May 2025. You see 75% of traders think that interest rate won't go down in May. In June as well, 48% of traders think it won't go down, though 41% of traders, 41.9 to be exact, already think that it might go down. So that's equilibrium kind of, right, in June, sorry. In July, it's also equilibrium. You don't see any big differences between these numbers. And in September, it's expected to go down one quarter point, which means one step. So, but what we care about is not just numbers, it's not just probabilities, but what we care about is change of probabilities, okay? For that purpose, we go to historical tab. And for example, let's watch the closest interest rate decision, which is going to be posted in March. Well, let's take May for the reference. And you see that these lines are going up. So for the current scenario of interest rate kept at the same level, the probability of the scenario rises to 71%. For example, a week ago it was 61%. Another week ago it was 49%. It was equilibrium. Right now it's 71%. What does that mean, by the way, guys? It means that yields of government bonds of the United States tend to not move down substantially. So these are yields of government bonds of the United States. So they are being supported. They stabilize in around 4.7%. If we take a look at yields basically, bond prices are moving down, yields are going up. So they are stabilizing. They are not very high, they're not sky high, but they are stabilizing. 4.74%. All right, so that means that basically the American dollar is being supported in this case. Of course, not just American dollar is supported, but also other currencies might be supported because they also have some expectations. When we're speaking about the currency markets, we are referring to the differentials between currencies. For example, some currencies are stronger, some currencies are weaker, and for money to flow into the US dollar, we need strengthening yields going up. So we have yields going up here, as you see that, starting from basically February 5th. So since the beginning of the previous week, okay, beginning of the previous week. So that's a calendar. Throughout the entire week, it's going up. Starting from February 5th, it's going up, and give me just a sec, guys. Just all right. What did I mention about? So I was mentioning I mentioned yields of government bonds that are keeping at the same level. So the American dollar is slightly supported. That's not weak. So this week is a week of support for the American dollar. However, tomorrow's publication will tell a story. So it will tell a lot about expectations. So after publication, for example, on Thursday, you can monitor CME Group's FedWatch tool and see whether this line is changing. For example, it's going up or down or stabilizing. You can check also June's meeting, and you may see whether the line is going up, down, or sideways, and that might give you the idea of a sentiment for American dollar, okay? If it goes down, for example, if these lines collapse, so that means that American dollar probably is weakening, so you may plan your positions according to that. So currently, at least for now, until tomorrow, so American dollar is slightly supported. So that's the story for today. Though, as I've said, ahead of inflation publication, big money usually stays out of the game. So they're sitting on the sidelines, waiting for the data to come in. And usually nothing is changing. By the way, today until tomorrow, markets probably won't make any significant moves, any tectonic shifts. We won't see that probably yet, because tomorrow will be volatility. However, some technical moves still would be going on. All right, let's go straight to charts. Enough with the sentiment, but we needed to go through the sentiment, guys. You need to understand that, because sentiment is a powerful thing. If you see that American dollar is strengthening or weakening, that might shape your technical analysis, because technical analysis is a wonderful tool, but it has one flaw. It doesn't tell you exactly which side of the trade to take. You may buy, you may sell, you may find evidence for any of your trading ideas, okay? So in our case, we see that the American dollar is strengthening a little bit. How does that relate to gold, for example? Gold usually is driven by the internal demand, and it's moving in a long-term swing already, which had started in December 19th. That's a wave of growth, a long-term wave of growth. I think that it is peaking right now. Strong American dollar basically pushes gold. Well, not now, of course, because gold is a hedge against geopolitics, against politics, against whatever it is, whatever it's against, that's a hedge that has internal demand. At the same time, strong American dollar, strengthening American dollar support pushes gold down. By the way, let's see what's going on with DXY, the American dollar index. You see that it's flat. It's not moving down, it's flat. Ahead of CPI publication, it's flat, but basically I think that it has some chance to continue ticking up a little bit, given the sentiment that we have now. And gold in this case probably is under pressure. I think today in the morning we had acceleration. We had the culmination of this move, and I'll explain you why. So you see this upside move, which was very aggressive in the night, in the Asian session, whether you guys have seen this move or not. This type of move with a further liquidation, the big liquidation. So I think that's the last uptick in the move. And here's why. So first of all, from the daily perspective, from the daily chart perspective, if we switch to the daily chart, let's count the number of bars or candlesticks in this wave. So it started in December 19th. Now it's February 10th, which is already close to 2 months. Well, I would say that's 45 days-ish or something, so I don't know exactly, I won't even count. I would say that's abnormal move. You see there was not a single correction, not a single deep correction in this move. Every correction which was going on here lasted no more than 3 days, maximum 4 days. That's basically an indication of a strong trend, very strong trend, but such strong trends, such strong, I would say, swings, not trends, but swings. Swings is a directional wave, which has a one direction without any pullbacks. That's a swing. So this swing is incredibly long. So statistically, that falls out of all observations. If you take a look at any swing that was going on in the market, you didn't have any similar type of swing. So each swing contained no more than 40 days statistically. Okay, for example, take this one before correction. That's, I think, 30 days, something, maybe 25. You may take this one, another 30 days, maybe maximum 30 days. I think less than that. If you take this one, also, yeah, less than that. So I think that this swing is coming to an end. If you just calculate the number of bars of candlesticks, you will get a statistical pattern. You will know that we are close to some peak, probably. We are close to some peak. Well, that does not necessarily mean that the market will turn necessarily into the big correction, though I think that given the culminations, the odds of correction increase, because ahead of corrections, usually corrections start with culmination moves like we have it now. So that's a parabolic move to the upside. I think that precedes the correctional move. If it was just peaking, just a regular peak without any acceleration to the upside, then that might be the range-bound action. In this particular case, I'm thinking, so I don't know, so that's incredibly difficult to say, but I'm thinking that we have good odds of a pretty big pullback here after this culminational move, because it's so-called one-time framing move without any significant pullbacks. The pullback is already very logical here in this case. And after this excess, that's an excess, the culmination, which is often called an excess in market auction theory. So if it persists, I mean, if there is no buyer, I don't think there would be any more buyers in control here. So it might liquidate to the downside pretty sharply. Well, as for me, so in the night I was just building a short position, so I'm still in the short, starting from close to the peak, though that's not a recommendation of any kind. So that's not a recommendation, that's not a trading advice. Though I think that it's absolutely possible to join to this move on the small pullbacks. For example, if it consolidates, pulls back, goes down, pulls back, goes down, so you absolutely can capture some of the pullbacks. Again, that's not a recommendation, that's only my view. That's only my view. I'm thinking that it might reach potentially 28.35, 28.25 something ish to $100 move down. That's a classical deep correction that usually happens in the market. $100, maybe $120 down. Statistically, that's a depth of the correction that might take place soon. Of course, tomorrow's publication of inflation might accelerate this move a little bit, because now it's a little bit technical. So it stands by waiting for the new data, for the new information. Speaking of the daily perspective, so if we take a look at the daily chart, market is located right above the value area, which is the area between 20 and 50-day moving averages. You see that? And basically the distance between the support, that's called often the dynamic support, the lower band is 2,800. The peak is $2,940, $141. So let's put average true range indicator to measure volatility here, and you would see here that average volatility is $32-ish, something like that, I think. So currently market is positioning at the 4 values of ATR above the support. Usually that means two things. Either that a market is in a price discovery mode, trying to capture new highs, new peaks, trying to find the new equilibrium, new balance. Usually that's a breakout situation, so something like that. I don't think we are there, because statistically it's probably the end of the swing. I don't think that a breakout will occur anytime soon. I think there was a last breakout so far. That's one thing. Another thing is it might be the indication of overbought market condition. Overbought market condition means that if it pulls back, the pullback is sharp, it's pretty massive, dramatic, and furious. Okay, it might even reach the support zone might be around 2,815, 20, something like that. Okay, so whenever that happens, market will lock in a range for a while, maybe pull back later, but until then it might go in the correction. Well, what is a trading idea, trading opportunity here? It's incredibly difficult to catch something here, to catch a short. Maybe you should wait until it pulls back, until it plummets, until it settles down, and after that you might jump in on another move, though this move might not be necessarily long-term. It might be just a short-term pullback, the regular pullback consisting maybe of 3 days, but these 3 days would be pretty much predictable. Because this trend, such a strong trend, never stops, or very rarely, I would say, stops immediately. Well, that's not a crude oil, that's gold, it's in high demand. Crude oil is a different story, it's been pushed down, even crude oil pulls back. But gold is in a huge demand right now, so that's absolutely interesting instrument. Okay, another thing which I wanted to point out, the position of the ATR, average true range indicator. So that's a cyclical indicator representing current volatility. So you see it fluctuates from the bottom to the peak, from the bottom to the peak again. Whenever it positioned at the bottom, it precedes strong or aggressive moves. That's exactly what happened here, for example. In October 2024, it was, you see, peaking, then it had established the peak, and then it collapsed, and volatility increased. The same situation we see right now, volatility is expanding a little bit. It has established the bottom in January 2025 this year. It's moving up and up and up, and volatility is increasing. Usually when the market is in the active phase of an uptrend, volatility probably won't increase in this case. It might increase, but usually the rise of the volatility precedes the correction or precedes the consolidation. So every time when we've seen volatility going up on the price action, we see the same pattern. Volatility is going up. When it picks, that's a pick on the price action too, or maybe not a correction, but at least it stops growing. Okay, another one also. Going up establishes the peak, so again market stops. Okay, going up establishes the peak, market consolidates. Going up, it's not establishing the peak yet, but if it, for example, if it pulls back, it might turn into a consolidation area. So that's not a trend, that's a consolidation area. That's very logical. High volatility is not good for investors because they don't like high volatility. I don't know, maybe such funds like Mizuho Bank or any other Asian financial institutions, they might act recklessly because they've done that in the past, so they just gamble in the markets. They don't care about volatility. But the majority of financial institutions, hedge funds, they usually don't like volatility to build their positions. They like low volatility, so they increase their exposure when they have low volatility. When the volatility is high, they're deleveraging, they're unloading their positions. With the gold, the situation might be slightly different, of course, because gold is a protective asset right now. That's not a stock, that's not a cryptocurrency, but deleveraging might be also visible on gold. Okay, so I think that's enough on gold. So I've outlined my scenario, potential my scenario for gold. As I've said, three factors. Let's sum it up together. American dollar is slightly in the tight mode, I mean supported. Gold is already mature, so this market is already mature, meaning that it's already past 45 days of growth. So the swing is probably coming to an end. That's a new all-time high, that's a new peak, and acceleration to the upside. So excess means this parabolic vertical move means the potential, exhaustion of the market, exhaustion of the trend. Let's figure it out. Let's see what's going on. So that's incredibly difficult to predict, but at least we might weigh some opportunities and try to figure it out. Okay, another one, crude oil. So another commodity market, though this time that's slightly weaker market than gold. That's crude oil. Crude oil has been pushed down starting from January 15th after this breakout from the range, which had started in December 2024. Then it had transitioned to the uptrend, then it had peaked, it had established the peak. Now it's moving down, and now it's retracing a little bit below the support area. So that's expected, I think, because all swings are not infinite. So they are not going on without any corrections, without any pullbacks. Well, I don't think that's necessarily the good opportunity to go to the short side. So generally the market is weak. So because of the different factors, bearish factors that affect crude oil. But is that a good trade location for short? I'm not sure. So I think that the market needs a little bit deeper correction. Maybe it needs some consolidation. Usually before going down, it needs to retest the previous intermediate term high, the static resistance, if you like, 74, and another one is 74.80. So two static levels which are built with the help of pullback levels here. So whenever or if the market will reach one of those levels, so that might be an indication of the potentially problematic zone for the growth. And here you might build or try to build a short position here. Until then, well, long position might still be an option, but I don't think that's a necessarily perfect trade location, because good trade location occurs at the beginning of the swing. On the second day, when you see the first day up, you may join on the second day or on the third day maximum. Now it's the fourth day. Well, it's basically the third day, right? Because it was Sunday. It was Sunday. That's not a day, basically. That's just the beginning of the day. All right, third day in a row. I think that's too late. But if you observe the upside action, so I think it might be possible to try to monitor for the short position here above the resistance, above the combination, above the value area, which is a zone between 20 and 50-day moving average here. So here it is. Here our potential zone of interest, of a short interest. So I would monitor for a rejection here, for the price to keep at this level. How exactly might that be? So if we go to the hourly time frame, so here is this zone. So what exactly would I expect the market to do? Well, for example, it goes up, it establishes some range, it makes a test and maybe a bullish trap, for example. Bullish trap is a breakout which is going to not work in this case. And for example, if you see some trading range and market breaking through the range, then returning back, that might represent the bullish trap. Well, I like, guys, I like bullish traps because they represent really good opportunities with a low risk and extended asymmetrical reward. So if you do everything correctly, you may catch the bullish trap, for example, and market may collapse further. You may use it not only for crude oil, but for any other markets. If you see that the market is exhausted, is already mature, wait for the bullish trap, for the fake reversal. That's one of the most powerful setups within a day, okay? By the way, also you can use Bollinger Bands indicator to confirm your trade location. That's very simple and easy indicator, but it helps a lot. I believe it helps a lot. So how does it work? You see that it goes with the price, but it indicates the potential borders of the trading range. So here how it works. For example, Bollinger Bands will move like this, and the price action will move like this, for example. It consolidates, then makes a bullish trap, comes closer to the upper border of the Bollinger Bands, and that might be the indication that the upside breakout is over, and that might be your trade location for the short position here. Again, that's not a recommendation. Test all ideas on the historical data. I encourage you to not blindly believe anyone in the internet, even a senior trading specialist at Exness, because that's trading, guys. You need to be able to build your own models. I give you the idea. You go test it on the historical data. All answers are hidden on the historical data on the instrument that you trade. So you can make a replay using TradingView, for example. You can make a replay, or you may just go back to the historical data and see if you had any similar situations. Just, I don't know, let's take any similar situation, the one from August 2024, just an example, right? Just an example, August 2024. Let's scroll it back. December, well, let's put here hourly chart, because it's really important, I believe, that finding a good trade location. I don't have enough depth of historical data, sorry, so let's find some fresher example. Okay, let it be here, October 2024. The same situation, the pullback, October. That's December, November. Well, let's put 4-hour chart, for example. On 4-hour chart, we have slightly more of a history. That's exactly what I'm talking about, guys. You see, that's 4-hour chart. On the 30-minute or 1-hour chart, that would be slightly different, but that's an example. So you see that that's the peak. That's the peak. Market violates the peak. Makes the bullish trap. That's the trading range. That is the market making a bullish trap, touching the base, touching the border of the Bollinger Bands. In this case, that's on a 4-hour chart. On the 30-minute chart or 1-hour chart, you will also see something like that. And then that might be your potential trade location for the short position. That might work like that exactly. All right. Now we have the same situation, February. So let's monitor for the action right here above the peak, this one or either this one, and see if we have any similar patterns right here. For example, market goes higher, establishes the range, makes the bullish trap, pulls back again. Okay, maybe it will be higher, I don't know. So let's see, let's observe. We don't have all answers, so just observe with a blind, or I don't know, blind, with calm mind. Okay, so don't connect too much to your ideas, don't marry your ideas. Okay, All right, Euro USD. So let's go through major currency pairs. Euro USD, so it stands still waiting for the inflation data. You see nothing really significant is going on here. If we remove Bollinger Bands indicator, leave only 2 moving averages, you see that nothing really is going on here. We don't have yet any new peaks or lows. Market is consolidating in a formation, in the consolidation or a coil, in other words, not indicating any direction whatsoever. When that happens, basically, when that happens, what are you gonna do in this market? If you don't see anything on the daily chart, any direction on the daily chart, the best guess would be to go to the lower time frame and to try to find some inefficiencies there. I mean, some price action within a day, intraday. So the best guess would be to, for example, start with a 4-hour chart to build the Bollinger Bands to understand the potential trade location in relation to the borders of the range. And whenever market is located higher or lower, by the way, let's put 50 parameter here because I think 20 is too sensitive here in this case. Exactly, that's what we need. Okay, whenever the market comes here or here to one of these areas, you may start monitoring for the reversal. That would be your best course of action, I think, in a range-bound market. Trading ranges break sooner or later, but in order to understand whether it's ready to break or not, technical picture won't tell you a story, but you need to check fundamentals, okay? For that purpose, you need to check fundamentals. Go watch FedWatch tool, CME FedWatch tool, and see whether those lines are moving anywhere or not. For example, how it can work. If you suddenly see, okay, for example, lines collapsing, some soft data comes in, for example, I don't know, weak inflation, for example, for some reason, or any weak economic data, lines collapse, for example. What in this case would you do? Of course, American dollar would experience outflows of capital in this case. If you see that, if you observe that, you would probably be positioning towards long for Euro USD. And if it comes to the border of the range higher, you are not expected to sell, because that might be the trend. Because American dollar is weakening in this case because of fundamentals, because not of technicals, because of fundamentals. In this case, probably the best course of action would be to try to join this move and to join this breakout. But if fundamentals don't change, if they stand still without any significant changes, probably big money stays out of the game. It's not interesting for them. Short-term traders dominate the price action. They are controlling the market right now, and you might try to capture the potential reversal point above the Bollinger. So that might be your course of action in this case. But until then, we don't see any shifts here, any significant shifts. Also, the same logic for ATR applies here. Ahead of big moves, ATR makes the new dip. Okay, we didn't yet have a new dip here, other than it's not a dip. I think that's a temporary point. That might be the new dip, might be here, but we are not there yet. We are not there yet. GBP USD was slightly pushed down, by the way, in comparison to Euro USD. It was pushed down a little bit, following the strength of the American dollar. It's close to the resistance in comparison to Euro USD, right? Close to the resistance, which is the midpoint, the value area distance between 20 and 50-day moving averages. And yeah, it goes up slightly, but it's built in this strong downtrend in comparison to Euro USD, which was already range bound. Well, I think they're pretty similar, right? They're pretty similar. We had some price action here to the upside, a strong upswing here from the market structure perspective. Then we have a downswing here, also pretty strong because it consists of several days, 1, 2, 3, 4, 5 days in a row. Pretty strong too. And the technical pullback, which is the 3 days of growth, technical pullback. I would say now we are in a downswing. We're located in a downswing because that's 1, 2, 3, 4, 5th day. Whenever the market closes 3 times, 4 days, 3-4 days above the peak, above the high, we're transitioning to the declining swing. So now we are in a declining swing. So given that, it's possible to play the continuation to the downside, I think. How exactly do we do that? Well, again, we don't need moving averages here because it's incredibly difficult to predict the direction. However, we might want to find some potential false breakout. So if the market establishes the trading range, then it breaks it to the upside. You may try to build your position like that, following this false breakout again, something like that. And again, the price would be located above the Bollinger Bands. Okay, it might be, so let's put it as a blue. If it comes here, so that might be the setup. So as I've said, guys, I like false breakouts, so I think they represent very good, if not the best, asymmetrical trading opportunities among other setups. I mean, short stop, extended move. So that would be my take on GBP USD. I would be monitoring for the potential continuation like that, in case, of course, if fundamentals won't change. For that purpose, of course, I will monitor the publication of inflation, what the number will be. For example, if it ticks up again 0.4, that's a strong inflation, but that's again the GBP USD moving down. If inflation fits expectations, so it's slightly weaker, then again GBP USD might go up. So fundamental moves break the technical thing. Okay, they override the technical thing. So first of all, if you see substantial changes in fundamental data, be careful, because in this case technical picture might also change. That's my take on the situation. So that's why I encourage all of you guys to learn a little bit of fundamentals, how to read fundamentals, how to read news. All right, what else do we have? So I think that Japanese yen, right? Let's straight analyze Japanese yen, because it was strengthening towards, weakening to the American dollar, and weakening to any other currencies. But that's a very good question, whether it will continue weakening or not. Actually, Japanese yen is pretty strong currency in terms of monetary policy, even though it was pushed down due to carry trade operations, because generally they big financial institutions, they take loans in yen, they invest it in treasury bonds, for example, or in other assets. So because even now, when the interest rate is 0.5% in Japan, it was minus 0.1 in the beginning of the previous year, but now it's 0.5, even though the loan remains to be quite cheap. Not that cheap as it used to be in 2024, but quite cheap. That's called carry trade operations. That's why yen is always pushed down and down and down in the long term. However, that's not the case maybe for other situations. So that's why yen in our case is weakening a little bit as of several 3 days, but generally it moves down. So I mean not the yen, but all currencies against the yen are moving down. So yen is in our case is moving up, because we can just watch it here. So yes, yen is moving up in our case against the American dollar. So I think that the yen is moving up due to the fact that it's a protection currency, that's a safe haven. Sometimes it's treated as a safe haven, and because of monetary policy, because monetary policy is weakening in both Eurozone and Canada, so interest rates are moving down, and it's expected to go down even more. As for Japanese yen, it's expected to raise towards, I think, 0.8 at the end of the year, at the year end. So in that case, of course, that's a long-term pressure. That's why it's interesting to see whether it will continue going up or not. I would say that usually in that case, strong structure tends to continue. Now this is a downswing. By the way, that's another way to build a downswing. So you can use zigzag indicator. it's not showing yet the current swing, I think, but you can filter it out a little bit using some other parameters. For example, let's put deviation of 2, okay? Well, it's moving down. We're in a downswing right now, so from a zigzag standpoint, but not just zigzag, just that from any other standpoint, we're in a downswing. Usually, I refer downswing as a situation when the market is closing, 4 bars. If it closes 4 bars above the low, then the swing is over. In that case, we might draw something like that. That's a structure. Now we are in a downswing, though we are located below resistance. And usually when that happens, whenever that happens, that's the point between the 3rd and the 4th day of correction might be a potential pivot point to the downside. Something like that. I don't know exactly how deep it will go. Maybe it will just retest the low of 150.51. But that might be the correctional move with a potential pivot here. That's why I will monitor something like that. Okay, give me just let's build Bollinger Bands for the sake of understanding the. Okay, so I think that's gonna play like that. So it might retest this area a little bit, maybe fade, and then move down, for example. That would be my scenario for USD JPY. If it works like that, so that would be pretty good entry point to the downside, because the structure of the trend is still down. So we don't fade the trend, we don't fight the trend, basically. The trend is our friend. The trend is our friend in this case, so I think that might be interesting opportunity to go against USD JPY. Though, of course, in tomorrow's inflation publication might shake up volatility a little bit. Maybe you don't want to join the action when CPI number is being published. So because volatility within the day might actually expand for, I don't know, 2 to 3 times within a day. And that might be frustrating because you see that the higher the volatility, the more distant stop you should place in the market. So for day traders, that's not a good option, actually. Day traders like low volatility because they place lower stop losses in this case. All right, what else do we have? Bitcoin, of course, last but not least. Bitcoin and cryptocurrencies, Bitcoin Ether, or Ether to be exact. Well, I would be fair to say that nothing at all was going on with Bitcoin after this liquidation. That's a normal situation. Liquidations worth of $2 billion were imposed in the market after tariff situation, after tariff announcement made by United States administration. And this candlestick was a tremendous shock for the crypto market. 2 billion worth of capital were liquidated from the exchanges. And whenever that happens, market needs to find the new buyer, the new buying activity, and it kind of just rotates back and forth without any significant volatility, without any significant moves. So that's exactly I think what is happening right now. So the demand or the activity is pretty muted. So market is in a shock. Of course, trend is still here. Trend has not gone anywhere. Trend is still here. Nobody dumps their bitcoins. It's no panic at all. It's just standing still. Though in order to find the new wave of buyers, I think it just needs time. It just needs time or any other trigger. I don't see any trigger here. I think time is what is needed here. It may be, time, it may take some time, maybe a lot of time, I don't know, to continue the action because the sentiment was pretty strong. Now it vanished. It just disappeared because of this liquidation. Everybody was expecting Bitcoin to reach 120, 135. easily, but probably that's not going to happen. That's, by the way, the feature of crypto markets. They tend to lock in long-term consolidations. If you take a look at the historical action of Bitcoin, you will exactly see the picture which I've described you so far. That's exactly after the rally, it locks in a long-term range. Then, for example, it collapses, locks in a long-term range. So rallies or periods of growth or periods of decline are replaced with extended consolidations. So with that, I don't have yet any urgent idea to buy Bitcoin. So I think that this action is going to continue for a while. I don't know for how long, until it finds the new equilibrium, until it will find the new narrative to drive it higher. I don't see it yet. I don't just see it yet. So I think that volumes on exchanges are dropping a little bit, and there was a dramatic shift in the futures on Bitcoin and ETH on the Chicago Mercantile Exchange. So it changed hands. Commercial traders were selling while speculators were buying on the spike. Meaning that speculators usually buy at the rising price, but they bought on the pullback, meaning that probably the market will stay here at this level, because commercial traders act as market makers in many cases. Because if they sell, market probably is going to rotate around this point for some more. ETH or ETH USD is even more gloomy. Well, it's in a downtrend. It has been in a downtrend compared to Bitcoin for some time, starting from December 16th. And I think it's gonna rotate around for 2,400. Well, not necessarily it will be today, but I think this rotation is absolutely what will happen here. Again, that's just an idea. Anything can change, guys. So don't treat it as a set in stone idea. So because markets are dynamic, the data always comes in, and anything can change pretty radically. But we need really the new piece of information, which we don't yet have it. What could be this information? Game-changing information for cryptocurrencies. That might be, for example, the official announcement from US government that it starts to accumulate Bitcoin reserves, for example. I don't know, maybe they already started. Buying it back on the liquidation. We never know that. But they might announce that, they make a verbal intervention, or any other interventions might work. But at least throughout the last week, we've seen that verbal interventions didn't work. For example, Michael Saylor, this guy from MicroStrategy, so he announced the big news from MicroStrategy. He called that MicroStrategy now is called the strategy. So all of a sudden, what do you think happened? Nothing at all. So market just ignored that. I think the son of Donald Trump, one of his sons, also tried to manipulate the market in Twitter. He posted, okay, that's a good time to buy ETH, he said. Well, not exactly like that. I think he posted something different, but he posted like, maybe that's the time, so don't thank me, or something like that. But actually, market completely ignored it and even reacted with some kind of a decline even. So you see that verbal interventions don't work in such markets, so it just doesn't work right now. So nobody believes these guys, these politicians. Nobody believes them because crypto traders think they betrayed them. At least they think that promises were false, and there was kind of frustration, disappointment in crypto industry after President Donald Trump becoming a president in the White House. So they see that no actions are being taken to support the crypto industry just yet. So he just imposes tariffs, he creates volatility and liquidations on the crypto market. That's current mood. It's pretty gloomy, but it can change. It can change, I don't know, in the future. All right, guys, I think that it's pretty much it for today. So thank you for listening. Thank you for joining our stream. So follow us on YouTube, on Facebook, wherever it's convenient for you to watch our streaming sessions. Put us a like, subscribe, and join us next Tuesday, the same time, on your preferred platform, whether it's YouTube, Twitch, or Facebook. All right, thank you very much. So see you later. It was Stan. Trade well, manage